Welcome to Indianomics. The U.S. 10-year Treasury yield has been rising for 5 consecutive months now since April. If October witnesses another surge in yields, it will mark the longest monthly streak of increases since 1999. So this is historic. What is significant is also the extent of the rise. From around 3.5% in end April to 3.7 in May, 3.85 in June to almost 4%, 3.95 actually in July, to an average of 4.1% in August and almost 4.6% in the last day of September. October began with one peep above the 4.8% mark. On an average, the yields have risen by 130 basis points in the last 5 months. While this is bound to have implications for growth and maybe loan defaults in the US, the 10-year Treasury is also the default benchmark cost of capital for the world. And hence, there are bound to be repercussions on monetary policies and exchange rates for most countries. To assess the reasons for this sharp rise, the future trajectory of the cost of capital and the impact on all countries in the global economy, I have with me 3 top-notch economists: Brian Coulton, the chief economist at Fitch Ratings, Robert Sockin, the global economist from Citi, and Aditya, Bhave, the senior US economist from Bank of America. Gentlemen, thank you very much. This is various time zones, so good evening and good morning, good afternoon as the case may be. Brian, first to come to you. What would you say is the prime cause? Is it the Fed indicating in the September dot plot that it intends to keep rates higher for longer and will cut very late and much less? Or is it more a fiscal problem?
I think it's a combination of the two. I think some of the earlier increases that you were referring to through August and September were probably largely about the Fed's message of higher for longer on rates. They're not going to be cutting rates quickly. And as that was happening, the market was kind of pricing out the view that the US would go into recession. I think more recently, though, we're seeing some concerns that if you look at what's going on with the rise in rates, it's more about real interest rates rising, and it's partly about the term premium, the difference between the yield and the so-called neutral rate, sort of, what the market expects rates to be over the next 10 years. And that's kind of pointing to us that maybe there's some increasing concerns in the market about the future supply of treasuries being very large because of outsized fiscal deficits, which look set to continue for a long time. So I think it's these supply issues that are now pushing up the real yield.
Okay. Your thoughts, Robert? If it is a question of term premium being impacted by future supply, then this is not going away very quickly. So your thoughts on to what extent is the fisc contributing to this increase in yields, and therefore how long do you expect the yields to continue to climb?
Yeah, thanks so much for having me. And this is a great question. On the term premium side, I think what we're seeing, our view as well, is that most of the move that we've seen maybe until recently has largely been driven, as Brian was talking about, to monetary policy expectations, the idea that growth is stronger. The Fed's probably going to have to stay higher for longer, the more resilient the economy is. And you saw that messaging from the Fed in their most recent dot plot, where they removed some of the cuts from next year as they started to upgrade growth. So I think that's been a big driver of it, but also there's this fiscal question in the background. And we do hear a lot of concern about this from clients. And if you look at the numbers, they are quite striking. We know the Fed is running off its balance sheet, so more of the supply is going to have to be bought by the private market. And we're running very large deficits. We're set to average deficits of 6%. Over the next several years, and that compares with deficits of around 3.5% in the years before COVID. So when you look at these numbers, they're very large, and we do think that in order to get the type of 10-year yields that you're having right now, you have to get some type of pickup, big pickup in the term premium. Now, maybe supply isn't driving all of that. It's really hard to tell the extent to which supply is driving up these yields. But it's certainly a story that people are focused on. I think if you look back to early August, that's when you really saw investors start to focus on this more, with the Treasury refunding, showing that issuance was going to have to step up significantly, and the Fitch downgrade, which brought to bear to investors' minds these fiscal challenges. I would make just one additional point, which is I don't think the market is fully aware of how much they should really be baking into the term premium, or hasn't really fully decided it. I mean, the fact that we're getting on second tier data like ADP, we're getting 10 to 15 basis points type move in Treasury yields really shows that the market is struggling to think about what the right pricing is here.
That's my point. That's why I was trying to distinguish between the monetary reasons and the fiscal reasons. If it's only a question of monetary, if the prime trigger was monetary, then any sight of bad news will be good news for bonds. But if it is a demand-supply mismatch, then we are likely to see the term premium continuing to rise. What's your take, Aditya? Do you think there is not just a supply issue, there is also a demand issue? Like Robert said, the Fed isn't a buyer anymore, it's actually a seller in a sense. And then, Japanese funds have their own JGBs to buy because the yields are at 10-year highs. A lot of emerging market countries are a little shocked by the recognition of Russian reserves, and they're also trying to diversify into gold. So is there a demand-supply mismatch? And therefore, Aditya, do you think yields can go above 5% or more simply because of the demand-supply mismatch?
Right. So I think all of the points that were raised are valid, right? There's a term premium issue, there's a fiscal issue, there's concerns that higher Fed policy rates are structural rather than cyclical, and those concerns have been growing. There's the continuation of quantitative tightening. So all of these factors are contributing to the increase in yields. The one thing that I would add is that these factors are not necessarily mutually independent. Right. So to the extent that the budget deficit continues to be elevated, that's expansionary in some ways. And the Fed would have to lean against that. So if a high budget deficit is structural, then higher Fed policy rates are also potentially structural, right? That can raise R star, and those can feed into one another and not only raise the 10-year rate for their own reasons, but also, together, and then impact the term premium, because all of this creates a lot of uncertainty around the outlook.
Now, I want all of you experts to tell me where we can see it head. Brian, that question to you. Do you get a sense that yields have still more to go because the fiscal demand-supply mismatch is perhaps yet to play out? There will be more treasuries that the Fed will have to issue because of the commitments that it has got into. So can we go beyond 5 and stay there?
Yeah, I mean, there's lots of different moving parts here. And I would say, one thing that we feel is that the Fed is maybe a little bit too optimistic on the path for the US economy. They really don't have much of a slowdown in growth at all. So our view would actually be that the US economy would weaken quite significantly in the first half of next year, and we're actually still forecasting a mild recession. So that would take some pressure off the labor market and might lead to some reassessment of this view that the Fed has set out in the dot plot. But I have to say, frankly, if we are wrong and the Fed is right on the US growth outlook, I think there is a real risk that the Fed has to take the policy interest rate above 6%. And on that scenario, I definitely see the 10-year yield breaching 5%. Now, that's not our base case view, but if we prove if it proves that the Fed is correct on US growth and there's a lot more dynamism in the economy in next year than we think there's going to be, I think the Fed is not done with one more hike, which is our base case view, but actually it could be 2 or 3 more. And on that scenario, definitely, I think see that the 10-year above 5% is a real possibility.
You guys at Fitch would be looking at the fiscal numbers even more closely than perhaps Robert and Aditya, I mean, since you'll rate sovereign paper. So that's why I'm asking you, Brian, yet again, that can the lack of enough buyers or a surfeit of supply overwhelming supply push the yield above 5%. I mean, what's your view on yield itself, the 10-year yield? Do you think it can stay above 5%?
Our base case would be that it would come off early next year, because, as I say, we're expecting the economy to weaken, and we think that will allow the Fed to start cutting rates next May, and they will cut several times. That's our base case view, and on that view, I think the 10-year would come off, because the interest rate outlook would then change significantly, and that would bring the 5-year down. But I'm just highlighting that there is a real risk that we don't see that scenario. But our base case view, I think, would be that the 10-year would come down. You've got to remember, this is the most liquid bond market in the world, and in a sense, these changes in yields themselves will potentially unlock some additional new demands. So I wouldn't want to overdo the supply concerns. I do think that's been part of the recent story, but I wouldn't want to overdo the weight of supply. Even though quantitative tightening is a big deal, the changes in Japan are a big deal. But this is the most liquid bond market in the world, and so changes in prices and changes in yields do lead to a response on the demand side. So let's not get too concerned. It's not like an emerging market where if there's big deficits, definitely pushes the price down.
I take your point on that entirely. I mean, we are beginning to see slight slowdown in remittances from Indians living abroad. And our guess is that's because the dollars are earning a decent amount of money abroad, and therefore, I mean, there will be buyers. I take your point. I want the view on U.S. 10-year yields from Aditya and Robert as well, but I have to take a quick commercial break. Back in a jiffy. Welcome back. We've been discussing the nearly unprecedented rise in U.S. 10-year bond yields with three top-notch economists, Aditya Bhave of Bank of America, Robert Sockin of Citi, and Brian Coulton of Fitch Ratings. Gentlemen, thank you for your patience. Robert, two quick questions. What is Citi's view of, where the 10-year yield will be? Will it be above 5%, and for how long? And can there be some accident consequences of people not being able to roll over their debt and therefore big defaults?
I think on this issue of can you go above 5%, I think the market's telling you you're getting pretty close, and it really comes down to these two issues we're talking about. How much are they going to bake in monetary policy expectations, and how much is the term premium going to go up? I think at these levels, if you're going to get to something like a 5% plus on the 10-year, unless term premium is significantly higher, it means that the markets are thinking that the Fed is going to stay with a policy rate, let's say well above 4% for the foreseeable future for the next 10 years. That seems very aggressive to us. That would be a pretty restrictive policy. Given that we don't think, in our view, our stars moved up very much. And so putting that together, I'd be surprised if it moved above 5% on a sustainable basis. But, maybe, as I said, maybe that the term premium really is moving up very significantly, and you can move above those levels. I think if you get there, to your second point, that is a pretty substantial tightening in financial conditions. These long rates are going to work into the economy through company borrowing and through consumer borrowing. And I think if you start to get above 5%, you might start to hear Fed officials maybe start to be a bit more concerned, maybe even starting to push back on this. And it puts into question whether they want to or need to do any more hikes, given that that's a pretty substantial tightening in the interest rate that really starts to affect the economy even more impactfully than their increase in short rates. So I do think you could get above 5%. I question if that can be sustainable. And then I think once you get there, if you do, I think the Fed's going to start to get a little more worried about the type of moves that we've had.
Your thoughts, Aditya, your yield trajectory or range for the next 6 months, say, and this accidents, when do the loans get reset? And therefore, any potential accidents in 24?
Right. So in terms of the near-term trajectory, our strategists do see a risk that the 10-year could go above 5%. Whether it could stay there is a bigger question. They do think that there's going to be significant resistance around the 5% level, so it might be difficult to break 5% and stay there. In terms of the risks of something breaking, those risks are probably pretty salient even at these levels, right? You don't need to get to 5% or higher. I would highlight that consumer balance sheets are pretty well set up to deal with these sort of risks, and also that because of the prevalence of the 30-year fixed rate mortgage in the US, consumers are not that exposed to higher rates, right? So mortgage debt makes up about 70% of total consumer debt, and a very large share of households are they either took out mortgages at a very low rate or they refinanced when the Fed cut to zero in those two episodes in 2009, 2010, and 2021. They refinanced to much lower rates. So the effective mortgage rate in the US, the average rate that people are paying on their mortgages, has only increased about 25 basis points, and it still remains very low by historical standards, even though the spot mortgage rate is much, much higher, right? It's increased by about 400 basis points. And then on the business side, I would be a little bit more concerned. There is a wall of refinancing coming up in commercial real estate, in kind of high yield stuff that would be more of a 2024, 2025 story. So we'll see where rates are by then, but that is something to watch for. And yes, something could break. And as Robert said, if there are risks that something breaks, then the Fed pushes back, which again raises questions about how long we can really sustain these higher rates.
Okay. Time permitting, I'll ask you as well, Brian, about whether a large part of the US consumer and companies have become rate insensitive because their loans are at fixed rates. But before that, I want to cover the impact on emerging markets. Do you think the US yields being where they are actually restricts a lot of emerging markets from loosening their policies? Countries like India, for instance, simply because you're so scared that dollars will run away.
I'm not sure it's such a constraint necessarily on monetary easing. I mean, I think as long as we don't see a kind of renewed surge in global food and energy prices, which were a really big deal for a lot of emerging market central banks a year or so ago, as long as that doesn't happen, I do think that the emerging markets moved quick enough and ahead of the Fed in raising rates that they've now opened up some space to cut rates. Now, obviously, the US rates staying higher means potentially more downward pressure on currencies if they do that. But as long as, say, oil and food prices don't sort of surge again, it's not necessarily a big constraint. I think there's a broader issue on just overall dollar funding costs globally are going to be much higher. And I do wonder if we're at the point now with the yield this close to 5%, where we're going to start to see a little bit more upward pressure on risk spreads than we've seen so far.
Very quickly, a last question to you, Robert. Do you think the fact that, as Aditya said, a large part of the consumer is insulated because mortgage debt is fixed rates in the US, does that mean that the Fed will have to raise more to get the impact?
Yeah, it's a great question and a set of points. And I think, to that point, if you look at consumer balance sheets, very healthy by many metrics. Net worth is very high. We just had massive revisions to the savings rate in the US last week that effectively boosted all estimates of excess savings from COVID, and also raised current savings rates that make them look closer to where they were pre-pandemic. So the consumer is looking like its balance sheet's healthy, it could stably continue to spend. That alone, I think, puts upside risk to growth and upside risk to inflation. And if you look again at overall debt service costs, as we were discussing earlier, they're still very healthy and at pretty low, running around pre-COVID levels. So you're not really seeing these interest rates impact the consumer in a meaningful way, particularly given this mortgage issue. I do think there are pockets that are getting impacted a bit more. I think on the lower end consumer, which leans more on credit card debt, you've seen that pick up some. It's still relatively okay relative to income. Those are getting hit by higher rates. So you are seeing in some segments, but I would agree overall, that the balance of risks are that the consumer is pretty insulated from these effects, and that they're going to maintain a lot of strength. And that could mean the Fed does have to do more, or at a minimum, just hang out where they are and hold that for longer. So I think that's the crux of this higher for longer narrative. It's the strong consumer.
Okay. Aditya, quickly, any takeaway for emerging markets here?
Look, I think it's a point of concern, right? What's unusual about the U.S. is when there are concerns about the deficit, the currency doesn't get impacted. In fact, the currency moves the other way. As yields go up, the dollar strengthens, and that obviously poses some challenges for emerging markets. So, hopefully for emerging markets, this sell-off in yields doesn't last for a long time. But if it does, I guess, fasten your seatbelts, because it's obviously having a big impact on risky assets, and EM debt as well as EM equities would fall into that basket of risky assets, right?
Okay, Brian, 10 seconds. What's your biggest concern now?
I think for markets, it's the point that the other guys have made, that the consumer just stays strong, and the Fed is not done with one more hike. They feel they have to do another 2 or 3. I think that takes us above 5%. I don't know how long we stay there. I think we probably get a deeper recession after that. That looked pretty ugly, and that would have a big impact on risk assets.
Okay. Gentlemen, thank you very much for joining me. As you can see, these are experts, and there are still a lot of ifs and buts from them on exactly how deep can the recession be, how long can the yields stay above 5% on the 10-year if they do get there. So lots of ifs and buts over here, but consequences can be nasty if yields stay long and high for a very long time. On that note, we wrap up on this edition of Indianomics. Thank you very much for watching.